Hello everyone, what's up? I hope you are doing well. My name is Daksh and I welcome you to Forex Monopoly, a channel where we learn everything about Forex and focus on being the 1% inner circle trader. In this video, I'm going to tell you about 3 different ways to trade breakouts. In the previous video, I told you what is breakout, and if you haven't watched that video yet, then you can check this out over here and then come back to this video. Now, before we move forward, if you are new to this channel, then make sure you subscribe and turn on the notification bell so that you don't miss out any new videos. Breakout is my personal way of trading. And the reason is that breakout trading provides us with a perfect entry and a perfect take profit and stop loss. Also, it is based on sort of a confirmation based entry. Like in breakout, what happens is generally when we are using breakout for trading, that is for placing our trades, what the price first does is it is literally trapped into some kind of level. And whenever a breakout happens, it indicates that a certain party, that is buyer or seller, won the battle. Like let us say if the price is stuck in this flag over here. When the price was moving inside of this, we had no clue if the price is going to move up or it is going to move down. But when at this point, when we have a breakout, we now know that the price can now go down. Why? Because the sellers have won the battle. Like this indicated the battle between the buyers and the sellers, and then this indicated that sellers have won. Now, other thing which breakout trading provides you with is a path of least resistance. Like not always, but most of the time when you are trading with the trend using the breakouts, then you most of the time are in the path of least resistance. That is, if your entry is good, if you get rid out of the fake breakouts, which I'm going to tell you how, then you can very easily make money through breakout trading. So now let us go to the chart and see how should we actually trade breakouts. The first thing that you need to do well for trading breakouts is drawing it perfectly. Now, I know that's kind of basic, but you won't believe me that 90% of traders draw the patterns or the levels incorrectly. And because of that, they get into a lot of false breakouts and then they are kicked out of the trade. The first thing is to draw patterns based on a particular time frame. What I mean to say is a pattern may be valid on a certain time frame and it may not be valid on other time frames, right? Like if you find out a pattern on 3 minute time frame, it may or may not be valid on 5 minute or let's say 15 minutes time frame. The idea here is whenever you draw a pattern based on a particular time frame, like let us say I am drawing this on 4-hour time frames. Like let us say I drew a pattern like this. What I will do is I will have to wait for a break on this particular time frame itself. Like if I am drawing a pattern on 4-hour time frames, the most important thing to do will be I will have to wait for this price to, let us say, move above this and then break out of it on 4-hour time frame, and it should form a candle outside of it. And only after that, what you can do is enter a trade. The first thing of drawing a pattern properly is to look out for time frame on which you are drawing it. Now the next thing is you may be able to draw different patterns on the same thing or the same price pattern. You can draw different types of patterns, like you can connect different lines. Like let us say if we move to 15 minutes time frame over here, right? On 15 minutes time frame, this pattern is drawn like this. But if you move to a smaller time frame, it may be a little different because there will be wicks outside of the pattern and you may not be able to connect it properly. You have to move to the highest possible time frame on which that particular pattern is valid. Like let us say if we move to 15 minutes time frame over here, you can see how clearly this pattern is valid. If we then move to 30 minutes time frame, it is again clearly valid. Just move to the highest time frame, like over here, you can see from on 1-hour time frame the price moved up, it moved down, then it again moved up and it again moved down, then it broke past over here. If you see on 30 minutes time frame, this pattern is accurate, but if you move to a higher time frame on 1-hour time frame, you are not actually drawing it properly. So what you have to do is here, first of all, whenever you draw patterns, you have to exclude wicks So join the starting body of the candle, and again here you will join the body of the candle. Now you can see how clearly the pattern has been drawn over here. Like over 30 minutes time frame, you must have seen that it was sort of something like this. So if you would have entered over here and your stop loss would have been, let us say, over here, the price would have took your stop loss. But when you move to a proper time frame, like 1 hour time frame in this case, and when you drew it, you excluded the wick and only connected the body, you can see how the price moved between these two, and then it broke past it. Price then retested it. It did not enter the zone or the pattern, and then it again moved down till a profit level. Like, let us take some more examples to understand what I'm trying to say. Like over here, let's first move to a smaller time frame. This is BTC USD 15 minutes chart. If you try to draw a pattern in this, you will see that this was the low, right? This was the low from where the price moved up, and now it moved up, and you will connect this body like this. So this is a pattern that you are getting on a 15 minutes time frame. But then when you move to 30 minutes time frame, let's see what changes. Now here you can see that the price actually, you will have to draw it like this, right? Here we have a sort of a fake out, and then price again moves into the line. Now again, if we move to a higher time frame, you will see, you will get the most important thing, that is this wick or the candle that you saw on 15 minutes time frame is not valid on 1 hour time frame, and always give more preference to a higher time frame. So what you have to do in this case is you will have to select this from here and just move it sideways. Like if you can see like this. Now you can see how an actual pattern is formed. Like you can see the price came here, it moved up. So price has reacted to it. Then again it moved down, it again moved up and created a high. Then it was not able to create a new high, and here it broke out of it. Hence indicating us a momentum change, and that the sellers have not now won the battle. And then the price moved around till this low over here, and you will just get out of the trade. The first thing was time frame. The next thing, which is very important, is to see if the price has really reacted to the pattern. Like in this case, you can see over here in this area, you can draw many patterns, but those are actually not real patterns. That is just a consolidation, and during consolidation, price may act like it is creating a certain kind of pattern, and your mind may think that there is a certain pattern playing out in the market, but that's not the case. So you have to be aware when the price is reacting to a certain kind of pattern or a trend line. Like in this case, here the price touched here, moved up sharply, consolidated, dropped down, then moved up sharply, and then again consolidated, dropped, moved up sharply, and finally was not able to move up, indicating that buyers have exhausted, and then the price moved down. So what I'm saying, that the price has reacted to the line or the pattern, is you have to make sure that you are not drawing a pattern in a consolidation and connecting any 3 points like this. Here we have connected actual moves, right? These are all actual moves. So you have to always be aware of that. Now again, let us take an example to understand this properly. Like if we remove the drawings, and if we now try to connect this, like here you can see how the price is consolidating and moving sideways. So in this case, you can see how after this the price moved down. This was our first move, then price moved up, stayed below this, and then again moved down below it. So this will be our second move. Again over here you can see that over here the price moved down, created a low, price moved up, stayed below this, and then created a low. This makes sense to us because price is actually reacting to it. So you have to always be aware of this. The third thing is you have to wait for a candle to finish or break out of the candle and finish it over there. Like let us say if from here the price is actually moving up, it moved up, so you'll have to wait for the candle to finish over here, and only then you can enter. After you have learned of how to find or spot or draw the patterns perfectly, the next thing you have to do is to look out for buildups. And why I'm saying build-ups is because build-ups is something that will, provide you with high risk to reward trades. Like let us say if we are ranging in this support and resistance area, this is support, resistance, support. So this is where the price created and build up and then moved out of it. What I'm suggesting is you don't have to enter over here. You always have to enter after the price has moved below this. But in this case, you have an tight stop loss that is you can keep your stop loss a few pips above this build up, and your take profit will be this much, like this area from here. Like what you can do is you can just select the measuring tool from this level to this level, that is around 6.5%, and from here you will take around 6.5% of take profit. But in this case you will not have to keep your stop loss above this, you will have to keep it above it. Therefore, if there is some sort of a build up happening near your breakout, that is a good sign. I'm not saying that after a build up the price is going to break the pattern in that particular direction where the build up is formed, but it actually provides you with an opportunity to keep your stop loss tight. Now let us take an example of what I meant by trading patterns with build-ups. Like if you see over here, we have a triangle like pattern, right? If we just draw a pattern, always be careful to connect the bodies. Like over here you can see how we connected this body to this one, and then the line moves like this. So here you can see at this point over here the price has created a build-up, right? The price is moving up and down over here. So when it finally breaks out of it, we enter over here, and after we enter we can keep our stop loss a few pips below this level. So what is happening over here is instead of keeping our stop loss all the way over here till this level, we can now keep it over here, and our take profit will be around this level, or we can also ride the trend if the market is trending. So in this case you can see how sharply the price started to move up, and the price is now doing the same thing. So this is how you trade breakouts with the help of build-ups. Now the next thing is always avoid breakouts that are very far from the structure. Like let us say that the price is moving down and then the price moved near the support, right? This is our support level. Let us say that this is our support level. When the price breaks this support and moves down, now the first thing that we will do is we will wait for the candle to complete, right? We cannot enter in between a candle. That is, we cannot enter before a candle has formed. Let us say this time the candle forms over here and it is finished too down below. That is too far away from our structure or pattern. So in this case, you always have to remember that let the price come to this area, let it retest it, and then you can get into an entry, or if you find an entry like this, just exit it. Because what it can do is it will just move up and it can just take your stop loss. And also your risk to reward will be very, very poor. Like let us say I entered a short trade after this. So my stop loss in this case will be over here. And even if my take profit is till this level, we are still getting a risk to reward ratio of 0.68. That is very poor. Let us take this for an example. Let us say that here you can see that the price is moving between these two lines, like the first touch, the second touch, and then this is a vertical line and this is a horizontal line. So price is kind of moving in a triangle. So here you can see that the price broke out of this pattern and it finished over here. The candle is formed at this point. In this case, if you enter a long trade, your stop loss needs to be below this for the pattern to be invalidated, right? Because here we don't have any kind of build up to keep your stop loss below this. In this case, if you enter over here, your stop loss will be around, let us say here, and your take profit would be, let's say over here. So your risk to reward in this case is very poor. It is around 0.56, and in my opinion is very poor. When you get into such kind of trades, the number one thing is most of the time what the trade does is the trade will just move down, take your stop loss if you try to keep over here, and then it will move up to your target area. It is always important that whenever you see such breakouts, just ignore it and look for other. These are the few things that you should know about trading breakouts, and in the next video I'm going to provide you with a strategy that I myself use for trading breakouts. And if you want to know about that, then make sure you subscribe to this channel so that you don't miss out on that important video. I hope you enjoyed this video, and if you did, then make sure you smash that like button. See you in the next video.